Today, I will show you how to automate accounting in Excel. We will start by chart of account. We see the different journals that we will book, starting from creating the company, then moving to the trial balance to see how the different journals and transactions are transferred to the trial balance. Then we will look at the end of the year, how to make the adjustment for the year end. Then moving to the next year, where we will see how to create to open the balance for the next year based on the balance sheet for the last year. Then we will see also the different transaction that we will see in this second year. Then we will look to the trial balance again for the second year, included different transactions, included the adjustment for the second year. And you see also how to link all the financial statement to different journals and trial balance. Here you can see a balance sheet is automatically created, and the same thing for the income statement. I will show you step by step how to do that. Also, I have created the cash flow statement. That's data coming from different journal booked in the system that we have all the cash flow statement automatically. So stay around. We will guide you step by step. You will see all the different accounting transactions. Then you will move to the different adjustment. So this document is available in my Udemy courses that you can see the full course for financial accounting and financial analyst, where also I included other topic like how to automate financial analysis in Excel. So the first thing that we will look to it is the chart of account. This is included all the different accounts that we will use in our accounting. So we have different asset class. The first part of account, which is included the asset account, included cash and cash equivalent. We give it a number 1000. This is just an example. It's depend to the country or the organization. So here we said that for the assets, it's class number 1, which included different assets, which is balance sheet account. There we have liabilities. We give it the class 2. So included different account for liabilities. Then we have equity. We give it class 3, which is included common stock, returning earnings, and dividend payable. Then let's move to the income statement account. We have revenue accounts. We give it class number 4, which is included different type of revenue and is part of the income statement. Now we have direct cost, which is the costs related to production, included direct material, direct labor, manufacturing overhead, and other cost of goods sold. So we give it class number 5. Now we have the operation expenses, which is the indirect cost. We give it class 6, which is included salaries and different other costs. Now we have class 7. We give it for the interest income or other income. The same thing for interest expenses or other expenses. For corporate taxes, which is part of the corporate tax expenses. So that was the first part, chart of account. So this is very important to understand the chart of account, because when you start to book transaction, you will see which account I will use. If I will purchase inventory, so automatically that I will increase assets inventory. So I will use the account inventory, and just we need to look for the account. And for the people who work in accounting, this is automatically come in your mind because it's by default by the time after practicing. In this sheet also, I have cash types. I create this table, which will be used in the journal. This is all the different transactions related to cash. I will show you later how to use it. As you can figure out, this is included the different items that you can find them in the cash flow statement. Cash received from customers, cash paid to supplier, and different items. So here, this will help me when I come to creating a financial statement. So I will, for each transaction related to the cash movement, I will use the type in order to automatically link it to the financial cash flow statement. So this included all the different items that are available in the cash statement. Next, we have journals for the first year, 2024. We have table, which included the date, account number. Then we have account name. This is automatically linked because here just we need to put the account number and we get the account name. So this will be automatically. Then we have description for transaction. So we need just to put the description for this transaction. We have debit side in accounting. As you may know that we have debit and credit. Always the debit should be equal to the credit for each transaction. So here we put the amount in debit and then we have credit. Then we have the cash type. So we just speak about it, which is the different type. When we book transaction, when we have cash movement, that means there is the account of cash is changed. So we give it to each account. And this is automatically will be linked to the cash flow statement. We will see that later on. So we have all this table and the total. And here I have put the total for debit. This is the total for credit, and that is checking. So to make sure that it should be 0, because the basic for accounting is to have debit equal to the credit. Then we have the trial balance. So the trial balance is summary for different accounts. All the account that we have in the chart of account. As you can see that this is linked to the chart of account sheet and the account type, the same thing. And for the financial statement balance sheet, the same thing. Then we have the balance. The balance is we use the sum if formula. So we get the data from the journal entries. So all the transaction that's booked in the journals will be automatically shown in the trial balance. So our criteria is to have, this is the account number, and we get the data from the journal from debit or credit. So it will be a summary for all the transaction that we have booked in the journal year 2024 sheet. Then it will be debit and credit. So it will be a summary and we get all the movement and the balance for each account that are available in the chart of account. Now here we have balance sheet. When this is the formula that we have created, you can find this formula in the sheet. We use the if function. So if the function here is balance sheet, so the balance, it will be automatically hidden here. If the same thing for the income statement, if this is income statement account, so the balance will be shown here. This will help us to figure out, is it balance sheet account or income statement? But in the financial statement, it's not very necessary because we will link it automatically. We create another sheet, the same as we have done for the first year. This is the same figure. As you can see here, that I have put the chart of account. So that will help me when I start to record it, because sometimes I don't know the account number or the description. So I just look in the right side and write the account number. Then we have the trial balance for the second year, similar to the previous one. Now we have the financial statement. Financial statement, as you may know, we have balance sheet, which is included assets and liabilities and equity. So assets include cash and cash equivalent. So this one, it will be linked to the actual balance automatically. You can use here XLOOKUP, but for simplification, I use the link directly. So here, almost all the accounts that are available in the trail balance, you can find them here in the balance sheet or in the income statement. So we have different accounts that are here. We have total and recurrent assets. we have the total current assets. So this is for the first year. Then we have the data for the second year, which is linked to the trial balance for the year 2025. And the same thing for the data for the year 2024 is linked to the trial balance. So property, plant, and equipment, the same thing, everything is linked here. So we have the total of assets, which is the addition of current asset plus the no current asset. The same thing for the second year. On the right side, we have liabilities and shareholders' equity. First, we have current assets. So all the data are linked to the trial balance. As you see here, this we put minus because in trial balance, we get, when we have credit side, we get the data in minus. And here we don't show the figures in minus. Credit liability is credit account. So it will be shown directly in positive. So we add minus. So we do the same thing for all the different liabilities account. We have loan payable account. Then we have common stock. We have returning earning, dividend payable, and we have the total shareholders' equity. Then we have the total liabilities and shareholders' equity, which is the addition of total liability plus the total shareholders' equity. So we have done with the balance sheet accounts. So we make sure that total assets equal total liabilities and equity. The same thing for the second year. Let's move to the income statement, start with the net income. We have seen before in the chart of account that we have different type of revenue. So we sum up all the revenue from trial balance from G24 to G27. G24, this is all the type of the revenue is linked to the revenue. Then we have the cost of goods sold. This the same thing. We have different type of cost of goods sold. We have seen before. We have direct material, direct labor, manufacturing overhead, and other type. So it's automatically linked. We get the value here. We put the minus figure in order to make sure to have the value in positive. Here for the revenue, we put the minus because when we make sales, it will be reported in credit. And in trial balance, it will be negative figures. So we cannot show negative figure in revenue. So we add the minus before the sum for all the income statement account. The same thing for the cost of goods sold. We add negative sign before the total. Now we have the gross profit, which is the difference between sales and cost of goods sold. Here we will show the cost in negative side. As me, it will be the addition of the sum of net sales with the cost of goods sold to get the gross profit. Now we have the gross margin, which is a percentage. It's calculated by dividing gross profit by net sales. Now we have total operation expenses. This is the indirect costs, included salaries, training, different type of account. That is part of the operation expenses. Here we use the XLOOKUP to get the value from the trial balance. Now we have total operation expenses, which is the difference between gross profit minus the operation expenses. Here you see it's positive, but is a plus, not minus, because we put the operation expenses in negative because it's cost. Now we have other income. You have other expenses, which is also linked to the trial balance using XLOOKUP formula. Then we have the net income before taxes. So this is the calculation for the operation expenses plus other income minus other expenses. Now we have EBIT percentage, which is income before taxes divided by revenue to get the percentage for the EBIT. Then we have corporate taxes. We use the X lookup formula to get the value for the income for the corporate taxes that should be booked in the expenses. Now we have net income. This is the amount left for shareholders, which is the difference between net income minus the corporate taxes. Now we have the net income percentage, which is calculated by dividing net income by net sales. And we do the same thing for the next year, the year 2025. Let's start our case. Our company is named Sportmax. The company was founded in January 2024, location in the United States. The company is in the industry, in the sport goods industry. So they have physical retail stores and online platforms. They target market amateur and professional athletes. So they have direct to consumer sales, both in physical stores and through e-commerce. We will do the journal entries for the year 2024. In the first year, we have 20 transactions that we will see together how to post them. Then we will see the different adjustment journals at the end of the year. We close the account and create new year. And we see how to create the financial statement, trial balance for the company. So let's start by the first transaction. So before we start booking the transaction, so we need to bring the chart of account. So it's better to put it in the right side. So we may need one booking deal. So here we have all the different accounts, and the account type is asset, liabilities, or revenue or cost. So let's start by the first transaction. So our first transaction is in January 1st, 2024. An owner invests 100,000 cash in order to start a business. Of course, investor put it in the bank. When we create company, we need to open a bank account and we transfer the money to our bank account. So here we put the date, which is the 1st of February 2024. We put the description here. Then here we said that we put the money in our bank account. So that means our account will increase. And our account here, you can see this is the account number, cash and cash equivalent. So we need to use the bank account. And we get the account name automatically. Then we put the exact amount, is 100,000. Here we have increased our bank. Then credit, there's no value to put it in the second transaction, second line. Then we have the cash types. Cash types, we said that when we have these accounts, the cash and cash equivalent, we need to add the cash type. That means we choose from this. Is it cash received from customer? No. Is it cash paid? No. So it can be proceed for issuing a stock. So we can use this one. So we use this one, proceed from issuing assurance of stock. Okay, so this is the first line. If you go down, you see that we have over 100 negative because there is credit side is missing. So here we put the same date or the same transaction. Here we need to put the account number. Here we said this is shareholders. So an owner invests 100,000. That means we need to use the account for shareholders. We have assets, liabilities, then we have equity. So equity, we use the account common stock. That means our capital for the company is 100,000. So we use the account 3,000, which is common stock. We put the value in 1,000. We go down, we see our debit equal to our credit. So that was the first transaction for this first year. Now let's start making analysis, we go to the trial balance, and we see that cash equivalent increased by 100,000, and we have common stock is minus 1,000. Always the total for trial balance should be 0 because debit equal credit. Then we look to the financial statement, and you see how does it look right now. So you see assets increased by 100,000. This is the first amount that we book in our accounting, and our total asset is 100,000. Now we look to liabilities. There is no liability so far, and we see that we have common stock for the same amount, and our total asset equal to total liabilities and equity. And you can see that our balance sheet is already changed. Then in the right side, we have income statement. So far, there is no movement for the income statement because we haven't booked any cost or revenue. Now we have the cash flow statement. And you can see that we have only one transaction. We have cash from financing activity. This is final. So we receive money from stock because we got money from stakeholders. Our cash at the beginning of the period, it was. Then there is cash changes for the period with 100,000. So we get the data from the journals, which is linked to the cash type, and we get, which is summary. So we use the summary formula to get the cash movement for the period. Then we have cash flow from operation. In cash flow, we have the cash flow statement included cash flow from operation activity, cash flow from financial activity, for investing activity, and cash flow from financing activity. Then we have net change in cash. So here, in our case, we have 100,000 as cash increase. Now let's move to the second transaction. The business purchased property, plant, equipment for $10,000. So we will separate them to make it easy to track our transaction. So here we have both fixed asset. So property, plant, equipment is fixed asset. So it's available in the asset account, it's balance sheet, and it's asset account. So we use the account 1,500. We get the account automatically. Then we put the description. So we said that it costs 10,000. Here we don't use cash type because this is not cash account. Then we use the same date for the second line. And here we said that on general business purchase equipment on cash, that means paid via the bank. So our bank account is 100. In the credit side, we put the same amount, 10,000. So here, with this cash movement, we look for the list. We cash paid for the equipment. So we finalize the second section. Trail balance to check if we can see that our cash and cash equivalents is decreased by 10,000. We received 100,000 from shareholder. Then we paid 10,000 for property equipment. Our fixed asset increase became 10,000. Our common stock remained this for the period. Now let's go to the financial statement. That then value, our cash became 10,000. And we have 10,000 as property, plant, and equipment, with the total assets of 10,000 remain the same. Then we have liabilities and equity remain the same, 100,000. For the cash flows, for the income statement, there is one so far. For the cash flow statement, that cash flow for investing activity become minus 10,000. And because we purchased equipment, then this is remain the same. And there is a net change in cash become 10,000. because this is the addition of the net cash flow from operation plus from investing plus net cash flow from financing activity. And we get the cash balance of 90,000. Now let's move to the third transaction. On January 15, the business purchased inventory worth 40,000. So the company, in order to generate money, so they have to start purchasing inventory. So the purchase for 40,000. Here we increase our inventory. So we look for the inventory in the account 1200 and put the amount which is 40,000. Then for the second line, we use the same period. We use the same date. Here we paid it in cash. That's mean we will use the cash account or cash equal the same amount 1,000. Here I put by mistake I put 400,000. If we go below in the total, you see there is error. So the total debit is not equal to the credit. If you are using accounting software, this is not possible because if you want to move to the second transaction or close the journal, this system will not allow you to close. So you need to correct it before. So here, 40,000. And here we said that this is cash movements. So we spend money. We check the cash types. So here it's cash paid to suppliers and employees. We finish the third transaction. We go to here, we can check with that's our total debit equal total credit. We check the trail balance. Use cash and cash equivalent decrease, become 50,000. Inventory increase, we have 40,000. If we go to the financial balance sheet, you see that cash and cash equivalents become 50,000. Our inventory is 40,000 and our fixed asset is 10,000. So the total assets remain 100,000. Our liabilities and equity remain the same. For the income statement, there is no movement so far. There is no revenue or cost generated so far. And you see here in the income statement that we have net cash from operational activity become 40,000 in negative because we spend money on buying inventory. Cash from financial activity positive, the same with 100,000. Now we have the net change in cash for the period, which is 50,000, which is the addition for all these transactions. Now we have the closing balance at the end of the year, which is 50,000. Here we compare it to the amount that we have in the cash and cash equivalent. We get the same. This is how you see how the cash flow statement is related to the balance sheet. The end closing ending balance should be the same as we have the one that we have in the balance sheet account, in the account cash and cash equivalent. Now let's move to the fourth transaction. On March 1st, the business made credit sales for 30,000. That means the company, they make sales, we increase our sales, and the sales makes on credit. That's mean the customer hasn't paid us, so we cannot report it in the cash and cash equivalent. So we have to report it in account receivable. So account receivable is 1,100. So we put the transaction, the description for this transaction, and we put the amount, which is 30,000. Then we do the same date for the second line. Here we said that this is sales. We do our chart of account. That revenue is class 4, and this is sales revenue 4,000. So we use the account 4,000. We get automatically the account. Then we see that we have a total of 30,000 as on credits for revenue generated during the period. Automatically, when we book the revenue, we have to book as well the cost of goods sold in order to match revenue to the cost for the period. So in this case, you have to book the cost of goods sold, which is found in the fifth transaction. So here, in the same date, the business incurred direct costs worth 18,000, reducing inventory. So we put the date here. We have increased our cost of goods sold. So we have to go to the cost of goods sold account. We have direct material. The account is 5,000. So we use this account. Then we put the description. Then we put the amount in debit. Then we use the second transaction. Here, we said that it will reduce our inventory. And the inventory account is 1,200. Then we have the amount of the inventory. So we have finalized the fifth transaction. So let's start checking. So here, if we filter the inventory, we said it's 1,100. This is similar to journal ledger. We have debit side of 4,000 and we have credit of 18. So our balance is 22,000. We can do the same thing for any other accounts like cash. Okay, you see all the movements. You can highlight some of the total cash in and total cash out to get the balance. This can be considered as journal ledger account. Now let's go to the trial balance and to see that our cash remains the same. Account receivable 38,000. Inventory become 22 because we purchased 40. We reduce it by 18. When we sell it, our revenue is minus 30 because it's credit. And our direct cost is 18,000. Let's go to the financial statement. Our inventory become 22,000 and liabilities remain the same. And you see there is movement in the returning earning. So what is 12,000? So this is automatically shown in the income statement. So for the returning earning, as you see, the formula that is linked to the trial balance. And the trial balance, we see that we have the line G24, which is the returning earning. Okay. Returning earning plus for G22 plus the net profit for the period. And we know that returning earning represent the profit for the period plus all the accumulated profit for the previous period. For that reason, we have linked it directly to the income for the period, and we add it to the return earning that is available in the balance sheet account for the previous year. And we get 12,000. Let's look to the income statement. We have net sales for 30,000, cost of goods sold for 18,000, and we get profit for 12,000. Then gross margin is 40%. There is no operation expenses incurred. Our operation profit is 12,000. Then other income or other expenses. Now we have net income before taxes for 12,000. Corporate expenses, there is no expenses right now. We will do that at the end of the year when we do the adjustment. Our net profit is 12,000. Is reported directly here in this case. And this is what happened in the accounting system. They will take the profit for the period. The system put it directly there, add it to the returning earning. And we do that the same thing because here we are automating accounting in Excel. Then we have the total liabilities and equities is equal to the total assets. Now let's move to the 6th April transaction. Here, 1st of April, the business paid 12,000. Here we will book the costs for the rent. This is leases expenses. We use the account 6200. Okay, let's go to accounting. So we use this account. So here, when you put any other account, so it will be get error message. So rental. Here we put description transaction, put the full amount. So here we don't have information if for 12 months or for the whole year. So we put so far, we book all the cost for the period in the expenses account. Then we do the same thing for the second line. So here we said that the business paid 12,000. So we pay it using the bank. So we use the bank account. Then we do the same description and we put the same amount in the credit. Here, there is cash movement. We need to indicate the type of the cash. This is cash paid for operation expense. We check again for the trail balance. Then we go to the cash flow statement. And for the first time, we have 12,000 as operation expense. The result become 0 in this because of we have the operation expenses reduce our profit. And for the cash, you see also there is movement for the cash. That's cash paid for operation expenses. It become 12,000. So in 30 June 2024, the business make another credit sales for 30,000, and the business incurred direct cost 70,000. So in 30 June 2024, so we use this is on credit. That means it's account receivable. We put the description for this transaction 30,000, and we put as well the credit side. And this is sales. So we said price 4,000 account. Then we put the credit side. Also, we need to book the transaction related to the material costs incurred, which is 17,000. So it will be the same period. The account will be 5,000, 17,000 as direct cost. Then we have the same date. Here we reduce our inventory. And we put the same transaction and we put included the same amount for inventory. Then on June 30, 2024, the business purchased office suppliers and utilities for 1,000 in cash. So we put the date, June. The business purchased office suppliers and utilities for 1,000. So office supplies, it should be expenses account. So we use the account 300. We put the description for this transaction. Then we put the amount, which is 1,000. Now we go to the second line. Here, this 10,000 was paid on cash. So we will use the cash account. And here the same description. And in credits, it will be the same amount. This is operation expenses. And you can check our different financial statements that our cash is decreased, become 37, the same value that we have in the income statement. Our profits become positive. Net income is 20%. Then we continue for the next transaction. On September 1st, the business purchased inventory worth 25,000. So here we purchase inventory. That's we increase our inventory. It will be on debit. 25,000. We reduce the cash account. Put the same description. the same amount should be in credit, and we put the type for this transaction, and we get 25,000. Next, on October 1st, the company makes out 50,000 loan in cash. So the company want to increase their business. So they ask for a loan from the bank. So we will get cash from the bank. We increase our cash and cash equivalent. So we put the amount on debit, 50,000. Here, because we use the account cash at cash equivalent. So we mention the category of cash in, and this is loan. We put the same date. Here we use the loan account, which is liabilities, because we have short-term or it can be long-term liabilities. Here it's a long-term. And you see that loan payable, which is account 2,500 or the. So we go to the transaction. We put the account. We put here the same value on credit. Next, on October 1st, the business paid 1,500 for employee training in cash. So this is operation expenses. So operation training, this is the account 6050. So we put the description. The amount is 1,500. So we paid on cash. That means we use the account 1,500. We bring the same description. The same value should be on credit. Then this is operation expenses. Next, on October 25, the business incurs salary and wages expenses. So we have salaries for 1,500. This is gross salary. Then there is tax payable, which will be paid to authority next. We have social security, and the net salary for this employee is 111,500. So we will put the date. So we put the account for salaries. We check here in the operation expenses. So the account 6,000. So we put the description. We put the amount in debit. This is the cost. Then we have to book the account payable. So this is liability account, because the company take it from the employees, income tax, then pay it to the government. So you have tax payable 2,200 and salary payable. Salary payable is 2,100, tax payable 22, and social security is 23. So let's start reporting this transaction. So we have the same date. So here we have 2,300. This is social security payable, which is here we put the same description. So social security is 1,500. And here we have 22, which is tax payable is 2,000. So here we put it in credit. Then we have social tax salary payable, which is the remaining account 2,100, and the value is 11,500. And we need to check below. You see if the value is correct. So debit equal to credit. So this is correct. Sheet, we see that our income statement is now less figures. We have more operation expenses. We have salary payable. We have tax payable, social security payable. So we have 15,000 that we need to pay to suppliers, to employees, and different authorities. So we will back to our transaction, and we make the transaction payment for salaries and for the tax and social obligation. The company paid the employees. So this is account for employees. So we use this account. Now in this time, it will be in debit. because we will reduce our salary payable, 1,100,000. Then this is paid with the cash, and we put the value on credit. So this is for account. If you go to financial statement, you see that salary payable becomes 0. So we do the same thing for other taxes that we will paid. So we consider one transaction, we put the date, and here we paid Social Security and both of them. So we bring automatically those accounts to make it easier. So it will be here is the same description. So here we put the value for Social Security, the amount we have Social Security 1,500, so it will be balanced for tax payable, which is 2,000, which will be balanced. Then here we have the amount that's paid, which is 3,500. And here we use the same date, and we use the account for cash and cash equivalent, the amount 3,500. Then we have the cash type, which is cash paid for taxes. So we have booked that transaction. Next, we have on October 2024, the business spent 12,000 marketing and advertising in cash. So we put the date, 28th of October, 2024. So this is operation expenses. We look to in the chart of account, the marketing expenses, 67. So this is the account that will be used. So we put the description here, and this is 2,000. For the second line, this is paid on cash. That means the account's 1,100. On credit, we put the same amount. And this is operational expenses. Next, on December 1st, the business pays 12,000 for insurance cash with effective for 1 year. Our insurance is for a period of 1 year, but we will book the cost for the period for 1 year. Then when it comes to adjustment, we adjust it to the period. So the account is 7. Put the full amount, 12,000 as cost, and we will adjust it at the end of the year. This is paid on cash, so we will use the cash account, and we put the same amounts in the credit. This is cash paid for operation expenses. Next, on December 15, the business made credit test for 45,000. This is account receivable. The amount is 45,000. Credit side puts the sales revenue with the same transaction, with the same description. Then we have 45,000 as total as on credit. So this is this revenue, the cost of goods sold for 23,000, which is related to the delivery of the inventory. So here is the account 5,000. Yeah, that's correct. Here is 23,000. So when that is reducing the inventory is 1,200. Then here we have the same description, and we have the same amount on credit for 23,000. Now we have only one transaction left before moving to the year-end, which is the collection of 45,000 from account receivable. So here our customer pay us 45,000. So we put the date, December. We have cash in because we receive money, the 45,000. In the cash type, we mention cash received from customer. The second line is the same date. So here it's account receivable, which is account 1,100. We put the same amount on credit. So here we have done with all the transactions that we have chosen for our case. So that's before moving to adjustment. Here we have the trail balance. This is trail balance before adjustment. You can see all the different movement. Then you see the financial statement here. Total assets equal to total liabilities. And we have income statement, and we have cash flow statement. Next, let's move to the adjustment for the first year 2024. Here we have, in this year we have 4 adjustments that we will see them all together. The first one is related to insurance. We have seen that during the year that the business pays 12,000 for insurance in cash, which is for a period of 12 months. We pay it in December. That means the cost is not related to the financial year 2024. It's mainly related to the next year. So we have to make adjustment at the end of the year. So the cost that not related to the financial year 2024 will be booked in the next year. We will do that using prepaid expenses. So as you see, it was paid in December. So 11 months will be considered as cost for the next year. We will start our first adjustment. So it will be the end of the year 2024, where we will use the prepaid account because it's asset. We go to the chart of account and we check for the prepaid account, and you can see is the account 1400 prepaid rent and insurance. We go to the journal, then we put the description. So it will be insurance for 11 months. Then we put the value, so it's 11,000 because 1,000 multiplied by 11 months. Initially we paid 12, so 11,000 or 11 months will be reported as cost for the next year. Here we put the same date. Here we need to use for the insurance account. So insurance account, which is the account 6500, it will be shown in credit because here we will reduce our expenses for insurance for this year. Debit equal credit, and we get the first transaction for adjustment. Next, we move to the second transaction, which is depreciation for the financial year. We have seen that at the beginning of the year, the company, they purchase fixed assets. In January 15, they purchased for 10,000. So here I have created depreciation calculation sheet where you can see the amount that we purchase. We said that the lifespan for this asset is 4 years. Then we calculate the monthly depreciation, and this is depreciation start period, which is February, because we purchased it in the middle of January, so we start depreciation this fixed asset in February. So the total depreciation for the year, it will be the amount of the monthly depreciation multiplied by 11 months. That's mean from February to December. We go to the journal. In journal, we put the date. Then we put the account for depreciation. We check in the chart of account, which is we found that the account is 6,800. So this is depreciation for financial year 2024, and now we put the value for depreciation. We need to add credit. This will be accumulated depreciation. Then we put the same value on credit. Then we have bad debt expenses. So in this case, we go to the financial statement. We check our financial statement. You see that we have account receivable for 60,000. And based on the company guideline, when we have at the end of the year account receivable, we need to make bad debt provision for this account receivable. In our case, we use 30% as the management decide. We need to book the cost. We check in the chart of account and you see that bad debt, which is the account 6810. So we need to book this transaction, which is part of the adjustment. So this is bad debt expenses for the year. And we said that our account receivable is 60,000 multiplied by 3%, and we get the value for bad debt. Now we need to book the credit. Then we go to the chart of account and we look for account that we reduce our account receivable, and we found there is allowance account. So the account is 1150, and we put the value here, then description, and we put the value on credit. Always check that total debit equal total credit. Now the last transaction for the year 2024 will be booking the corporate taxes. So in order to do so, we need to go to the financial statement. First, we need to check if our value is correct and see if our financial statement is correct. Our debit equal our credit. You see our income statement for the year, and you see there is net income before taxes for the amount of 10,408. So this is the amount of the net before taxes. So we need to multiply this amount by the corporate taxes to get the amount of the tax. Let's start by booking our transaction. So corporate taxes, we go to the chart of account and you see that this is account 7200, and we put the description: corporate taxes expenses financial year 2024. So here we put the amount for the EBIT. We have found that it's 10,408. We multiply by the percentage of corporate taxes. In our case is 20%. So multiply by 20% and we get the value for corporate taxes. Now we do the same thing for credit. So here we need to use liability account, and we have tax payable account. So we can use this account, which is included all the tax related account. So corporate taxes year 2024. So we put the same amount on credit. So our debit equal to our credit. So here we have finalized the first year. Let's check our financial statement. You see that we have the bad debt that we have recently created, booked. So we found the bad debt, depreciation, and all the different expenses that booked in the income statement. And we have net income for the year, which is 8,327 with a percentage of 8%. Then we have our asset with a total of 160,000. Our liabilities and shareholders equity the same value. Then we have the cash flow statement for the year, which is ended with 82,000. We compare it with the value that we have in the cash and cash equivalent, and you see that there is different 76,500, and when we go in the cash and cash balance, we find another amount. So this is not correct. So we need to find out the error. So we go to the journal entries. We start to make an analysis. So here we can filter. we check all the transactions related to this account, and you see that we have some account that we haven't used the cash type. So this is business paid for 1100 for salaries, so we need to add the cash type for this transaction. So we select this is paid for salaries, so salaries and employees. So this is similar to general ledger for account. You can see all the movement for our bank account. Now we're back to the financial statement. You see that cash and cash equivalent at the end of the year, which is 76,500, and in our balance sheet account, which is 76,500. So this is one of the way how to check the financial statement for the company. Now we look to the financial statement. Now it's time to create a new year. So we will see together how to create the financial year. So the financial year 2025, it will be based on the creation on the opening balance for the next year. So this will be based on the closing for the year, then created the opening. We will go directly to the opening to see how we can create opening balance. So the opening balance will be created based on the trail balance for the last year. So here we need to bring, when we do the opening, we need to take on consideration only the balance sheet account. So we filter only the balance sheet account, and we take only the account that we have account number. So we will do, as you can see, this is the account that we have. This is the total value that we have. So we need to take them to the next year and creating the opening balance. So the next year, journal for the next year. So it will be the 1st of January 2025. This is opening balance for the financial year 2025. We will copy these accounts. We take them to the next year in January. We bring all the account, then we will bring the values as well. We put all the values here. The values, some value are in debit and some of them are in credit. So the value on credit, we can, in negative, we put them on credit, then we can remove them. Then we have this account, which is liabilities and equity. We will take them on credit, then we remove the negative sign. Then we check if our debit equal to our credit, and you see there is a difference of 8,326. We go to this financial statement, and you see this is the value for returning earning. These accounts are related to the P&L account, so we can find them here. So this account will not take them for the next year, so it will be reported in the account returning earning. We go to the we go to the chart of account, we look for returning earning. This is the account 3100, and we write it here. Then we put the value for the earning for the year, so we bring it directly from the income statement and we'll write it. Then we check, and you see that the total debit equal to total credit. So this is the transaction for the opening balance for the next year, where we have reported only the balance sheet account. The income statement account will be cancelled and will be reported in the returning earning. So here we have it, we have added returning earning. So this is the first transaction for the year. Now we will go directly to the next transaction. Before moving to the next transaction, we will check our data in the incomes in the financial statement. You see that our financial year 2024 equal to 2025 because there is no transaction booked yet. For the income statement, it's zero value. And for the opening balance, you see we have only amount for 76,000, which is related to the opening balance for the financial statement. Because here, when we use the account cash and cash equivalent, always we need to give it the type. Here we said this is the open balance for the cash. Next, we will move to the next transaction for the financial year 2025, which is most of them are similar. Then we will look to the adjustment transaction for the year. So for the next year, we will do almost the same transaction. So in order to save time, I'll go to them quickly. So we have inventory. This is we have seen before. Account receivable. The first transaction, we buy inventory. We paid with the cash. So we use the cash type, which is 11, which is cash paid to suppliers. So this is all the transaction that we have booked during the year, different purchase and sales. Then here we have, if you remember the last year, we have booked for bad debt. So here we receive money from customer, we get cash in, so we have to cancel the transaction related to the bad debt because we get the money from customers. The same thing for salary that we have paid, taxes, and at the end of the year, so we calculate depreciation for all the equipment that we purchased during the year. So there was last year purchase, then we add this year purchase. You can see that we multiply by 12 because the equipment was purchased the last year. So this year we calculate depreciation for 12 months. Here we have a new office furniture that we purchased in February. So we calculate for 11 months. This account will be booked depreciation for the year, and our accumulated depreciation increase. Instead of 2,292, we have 5,938, which is depreciation for the last year, included depreciation for this year. Then at the end of the year, we need to look to the financial statement to see our account receivable. The same value, we have 60,000. So we need to calculate the bad debt for the year, which is 60,000 multiplied by 3%. Insurance. In the last year adjustment, we have booked the prepaid rental and insurance for 11 months. Here in this year, we need to book the insurance cost related to this year, and we cancel the prepaid insurance with the same amount. And the same thing for corporate taxes for the year 2025. We look to the amount of the depreciation. We look to the amount of the EBIT. We see that in the year 2025, we have 18,000. So multiply by 20%, and we get the value of 3,771. And we put the same value on credit. So this is the final transaction for the second year. Now financial statement are ready, included the balance sheet for both year. We have total asset for each year. Now we have total liabilities. Now we have the income statement for the second year. You can make comparison between year one and year two. You can make analysis for this deviation. Now we have financial statement where you can see the different movement for the financial statement. So in my Udemy course, I have created all the details for the different analysis for the financial statement, included growth analysis, ratio analysis, where you can see different ratio that we have calculated, and everything is automated in this Excel file. I hope that you find it useful. Please give me your comment if you have any question in your comment about the course or about anything that you need to know, or any other type of course that you need to see. Please don't forget to subscribe to our channel, to hit the like button if you like the video, and see you in the next video. Thank you very much.